Opportunities to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manoj Menon, Head of Research, ICICI Securities. Thank you, and over to you, Mr. Menon.
Hey, hi everyone. It's a wonderful good morning, good afternoon to you from India. On the auspicious day of a celebration day today, thanks for taking time out and joining this call. Now I just hand over the platform to Ms. Nidhi Verma from TATA Consumer for the introduction of the management and for further proceedings. Nidhi, over to you.
Thanks, Manoj. And hi everyone, and welcome to our call. And thanks for taking the time to join us today. We announced our results yesterday and published all the materials, so hopefully you'll have some time to go through them. But for today's call, I'm joined by Mr. Sunil D'Souza, Managing Director and CEO, Mr. L. Krishnakumar, Executive Director and Group CFO, and Mr. Ajit Krishnakumar, COO. So in terms of the format, we'll spend about 15 minutes or so walking you through the key highlights during the quarter, and then we will open up the floor for Q&A. So for further proceedings, I'll hand it over to Sunil. Sunil?
Thank you, Nidhi. So if I can go straight to slide 6 in the deck, which is the executive summary. During the quarter, we grew by 11% on consolidated revenue, 10% in constant currency terms, despite huge volatility and inflationary headwinds. On a 3-year basis, this is 12% revenue growth. Expanded our margins, EBITDA grew 14%, 13% in constant currency, up by 40 basis points. EBITDA margin is now 13.8. India business grew 1% volume in India beverages and revenue of 3. India foods volume growth was a bit soft as we took strong pricing in respect of inflation which we're seeing in that business, but revenue up 19. In the international business was up by 9. Margins more or less maintained in the international business, gross margin. Segment margins India expanded 20 basis points despite cost inflation in salt and significantly higher A&P. We continue to invest in our brands, while overall as a company we upped our A&P by 34. India business was up 48, and that shows the market share gains in both tea and salt. Innovation momentum was accelerated, and we had several new product launches across all our platforms. And group net profit increased by 58%, led by higher EBITDA, and most importantly, improved performance at JV and associates. We also announced a new sustainability strategy with holistic goals and targets. I'll straight move to slide 9, which is a summary of our key businesses. Yeah, so in India beverages, I talked about volume up 1, revenue up 3. India foods, volume -3, revenue up 19. US coffee, again, strong pricing actions in line with commodity trends out there, volume down 3, revenue up 20, and as you see, market share beginning to trend up there. International tea, volume growth -2, revenue up 2, because all the pricing actions that we've taken have not translated into the market, given the fact that we deal with several large customers. But we solved that puzzle end of last quarter, and we should see better traction going forward. TATA Coffee volume growth up 8 and revenue up 25, driven by coffee prices, all in 3,327 crores of revenue, up by 11%. Next slide. In terms of metrics, I think you saw flow through completely. 11% revenue, 14% EBITDA, 14% PBT, and group net profit up 38. Most importantly, EPS is up by 38, and we're sitting on 1,900 crores of cash. If I move to slide 12, just to give you highlights of where we are on our strategic priorities. We were on 1.3 million, we committed 1.3 million outlets direct reach in March, which we completed, and we said we're targeting for 1.5. Going trends, we might be slightly ahead, but as of now, we'll stay with the 1.5. But most importantly, we said we have to now get the wholesale multiplier as we pump in innovation and A&P through our distribution system. Wholesale coverage is up by 2x from 19,000 to 38,000 outlets. Most importantly, also all our alternate channels are firing full speed. Modern trade is up 35. E-commerce, which we had ended at about 7.5% of sales last year, is now up to 8.2, and the 2-year CAGR is 73, very healthy trend. Next slide. We are continuing to power our packaged beverages. Overall, India business A&P is up by 48%. Coffee is now growing very, very healthy for us, up by 73% for the quarter. But we have about a 3 to 5 share depending on which geography you take into account. And we continue to inch ahead on our market share in base tea. Next slide. On salt, we continue to power A&P, but most importantly, we now will start ramping up our investments behind Sampann. We have always said that the opportunity in salt is both on top of base TATA salt as well as below. So rock salt and premium salt overall have been grown significantly. And we had launched this new variant of fortified salt as a pilot in Delhi. That's doing very well. With a few tweaks in the marketing mix, we will now be rolling it out across the country. Most importantly, our salt share is in the ballpark of 38% and continues to show 400 basis points improvement over last year. We are fueling innovation. The first slide, I think, is a critical piece where we are rejigging our blends, the whole marketing mix across the country. But most importantly, 40% of the spice market is in the southern markets, where we have not played seriously so far. We are now customizing both product and communication to match the southern markets. Just started our rollout in Andhra, Telangana, and we will be shortly entering Karnataka. But we'll go. All I would say is watch this space. Moving from coffee into cold coffee, we probably were a slight bit late to this season, but going forward, we feel very good about this product. Expansion of portfolio in Nourishco was another big thing, and we have launched TATA ORS on a pilot basis in specific markets. And internationally, also, we continue to expand with the sweet tea cold brew in the US now. We had, when we had acquired Soulful, we had said we acquired Soulful not only for what it is, but what it could be. And we had said that is going to be the base brand for our platform in breakfast, cereals, mini meals, and snacking. Now that we've got the base business more or less tightened up, now we are expanding. This is our first of many more innovative launches, expanding categories in the platform. A blind taste, it is a winner versus the market leader. We are already about 5 to 8 share in about the last 60 days since launch in markets and outlets where we are present. Next slide. Himalayan, we figured that the share of equity and mind space in consumers is far ahead of our share of wallet, and we have the opportunity to expand this into many more segments. So we are transforming Himalayan into a provenance brand. You will see many more opportunities coming up for Himalayan, but now we started with jams, preserves, and honey, all sourced authentically from Himalayan or from the Himalayas. Next slide. The other thing in this quarter is we have always said that we have a 4+1 platform play, not elaborated too much on the +1 platform. I think by now everyone on the call will be familiar with the fact that we have entered the protein platform. I would highlight saying that we've entered the protein form and not only a product. In the next slide, the first category that we're entering is alternate meat. We've launched TATA Simply Better. Off to a good, albeit it's just 2.5 weeks old, and we see a lot of potential. Unlike many of the competitors in the space, we've got a winning proposition both in terms of the protein content in specific products, the taste and texture feedback from consumers, and most importantly, an ambient flavor which then allows us to expand our distribution with far more than competition. Next slide. We've always maintained that while we will strengthen and accelerate our core businesses, we will co-funding our field of play. Our new engines of growth last year delivered 52% growth. This year also continuing the trend, Q1, they're up by 53. awards in sustainability, but most importantly, slide 20. We've announced our new sustainability strategy. We've already put it out in public. Better sourcing, better nutrition, better planet, better community. Detailed items under this, detailed targets. These are stretch, good thing, achievable targets which we aim to deliver. Whether it is supplier assessments or sustainable products in one form or the other product form, or in the climate space, net zero, water neutral, zero waste to landfill, and packaging, or committing to diversity in the workforce. We have now very specific targets with very specific timelines which we aim to deliver over a period of time. In terms of the macros, on the right-hand side, commodity trends, a little bit of softening, but albeit overall versus last year still higher Indian teas, which translated to a bit of inflation in our international geographies because of inflation pricing. In India, tea was broadly operating in a range, a small bit of a blip, I would say, with the floods in Assam mid-June to about early July. But given the broad-based trend of supply greater than demand in India, we do expect to start seeing the secular trend coming back. Coffee prices having hit a high of about 260 per pound sometime back and now operating more or less range bound. And given what we are seeing in India, etc., which is where coffee prices are fixed, we expect them to be staying in this piece. Good news is we've taken pricing primarily our coffee business in the US to account for this. I'll move to slide 28. Yeah. So here's some of the businesses, Indian packaged beverages, 1% volume growth, revenue down because we have re-indexed pricing in line with softening tea prices and 40 basis point share gain. Next slide. India Foods, volume was -3, but just to point out that vacuum evaporated TATA base salt was flat despite the pricing that we've taken. And that is, our overall pricing actions have translated to 19% revenue growth. Most importantly, with the new price hike that we've just gone in with, moving our prices from 25 to 28, we do think margins will be back on track. And as you see on the slide, we're continuing to hold on to market share gains. We are 400 up versus last year. Next slide. Narisco, very, very strong trajectory, 110% revenue growth, 180 crores for the quarter. Narisco, this is the first summer that they've seen since we've taken over. And like all beverage majors, as the heat wave, extended heat wave hit northern India, we were also hand to mouth on capacity, and we therefore, as we expand geography and portfolio, we see bright future for this business. Next slide. Extraction and coffee plantations drove revenue growth to 25%. Next slide. First, again, you've got to remember we're cycling quarter of the lockdown last year. But now we are at 235.99% of stores have reopened. There's 30 cities. Strong wicket, a bit positive quarter for Starbucks, which shows the power of the operating of Starbucks and therefore the ability to generate value in the longer term. Given it's a 25% increase in same-store sales versus pre-COVID, we do feel good about the business. International, slide 34. We're more or less maintaining share in everyday life in the UK, but most importantly, we have put money behind A&P for Teafix, which is a super premium brand, and we've seen a 16% revenue growth there, and overall the business delivered a plus 3% revenue growth. Slide 35, coffee bags, we are now climbing back on share. Tea was a bit soft, but I think it will get corrected over the cycles. Overall coffee revenue growth of 15%, primarily driven by pricing. Canada, our star in the international market, continue to maintain share, growing specialty tea and overall delivering 14% revenue growth. And I hand over to LK for a quick snapshot of financials.
Thanks for this. I'll just talk you through the summary financials. Starting with the consolidated, we'll see that revenue was 3,300 crores, grew by 10% in constant currency. Within that, India business grew by 9%, and India business, the core portfolio grew by 20%, and the growth initiatives, which are basically water, sub-fund, Soulful, and the like, grew by over 50%. International business revenue growth of non-branded also had a stronger quarter because of the coffee prices and higher volumes, it grew at 25%. In EBITDA terms, the growth was 14%, and with the improvement in EBITDA margin, driven by the India business, largely by tea, but also overall cost on common cost. International business grew by, EBITDA grew by 9%, and non-branded business had higher EBITDA. Moving on to the next, and on the standalone, just go back to it. On the standalone, we saw revenue growth of 6% and EBITDA growth of 12%. Let me just clarify that the EBITDA, which is shown here, is sort of derived from the stagnations, where we've taken out the other income, dividend portion, and kept only the operating income to give you a reflection of true performance. So, the underlying performance from EBITDA growth. Moving on to the next slide. Again, talking first about the consolidated results, revenue from operations 7%, EBIT, higher EBITDA margin improvement. I want to point out the PAT number, 277 versus 241. And as you move to group net profit, for this current quarter is the same as the PAT. That means the share of profit loss from JV associates is zero at breakeven, compared to a loss of about over 40 crores last year. This basically reflects improved performance of TATA, as well as plantation, which is a North India plantation that we have. Both performed extremely well in this year. So that on standalone, we've seen that operating EBITDA grew by 12%. PBT, it is sort of lower compared to the same period last year, largely because of dividend and investment income. Within that, mainly because of dividends, we had a significant dividend flow from the overseas entities in the last year. We expect to have some of the dividend flow in the later part of the year. It's also to do with the restructuring plans that we have. We are hoping to complete with necessary approval. So moving on to the next slide, which is segment-wise performance. Both revenue and EBIT of the India business is 72% of the overall branded business. And within the individual components, we are reporting India business on a consolidated business basis, because that's how we manage different product portfolios within the India business. So overall profitability higher than revenue growth of 9%. International business profitability in line with revenue growth. And couldn't talk through individual parts. I think overall we have been able to take price up in a competitive environment and maintain volume. We have seen strong volume growth in the growth business for part of our portfolio, which is water, Sampan, and also Soulful. Sampan performance was slightly muted because of certain reasons which Sunil mentioned, but we expect growth to come back strongly in the quarter ahead. That's it from my side. We are happy to answer any questions.
Just a quick summary of what we're seeing going forward. Inflation and volatility, I think, is a reality. We will have to keep moving plus and minus depending on where it goes. We will focus on driving and balancing both growth and margins. I don't think it is an either-or situation. We've got to manage both. Just to put it in perspective, that if you look at the last 3 years, we've delivered a very healthy CAGR of 14% in beverages and 19% in foods. Salt costs, where we thought the cost inflation was behind us, and we moved from 24 to 25 in the last quarter. Forex moving against the Indian rupee and the cost of coal going by roughly 2.5 to 3x of what it was last year. We now moved the pricing from 25 to 28. That's it. I mean, like for me, the most big indicators in a volatile environment are maintaining margin and market share, so that you continue to balance between all these three, including top line. businesses are on a strong trajectory. You've seen the 50% plus. Given the lockdowns, hopefully behind us, our out-of-home businesses, Narishko and Starbucks, should continue to deliver momentum. Tata Soulful, strong momentum, triple-digit growth, which will continue to drive as we expand portfolio and enter newer categories for the platform. International business, we have taken strong price actions. In the UK, probably it is just about landing because it took some time to translate into the large outlets, but that also should be on a good wicket. The most important thing I would want to highlight is we manage the overall business as a portfolio, and we will have puts and takes in certain businesses depending on what we are seeing as opportunities or headwinds. With that, back to you, Nidhi.
Thanks, Sunil. So moderator, you can connect you and we will start taking questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Yeah, thanks. My first question is on Sampann and two, three subparts to that. First is in your presentation, you have mentioned short-term impact of trade term margin rationalization and realignment. So if you could elaborate. Second is, at the company level, your gross margin is 43% and EBITDA margin 13 to 14%. Sampann, I do understand currently will be actually EBITDA margin will be much lower. My question is on Sampann, say 4 years down the line, when things stabilize, where do you see versus the 43 GM and 13 EN at company level? And last part is the 5% GST which has been put on packaged cereals, pulses, etc. You see a big benefit because of shift from the product side.
Yeah, so thanks, Abneesh. Let me take your question. So number one on Sampann, very specifically in the quarter, we corrected some channel and trade margins. For spices, about 25% of our mix comes from online. For pulses and spices, about 40% comes from online. So we did take certain margin corrections to make sure margins are on the right track. In a business like Sampann, which is a high growth and probably I would say not low, mid margin, you've got to make sure that the ballpark margin is right as you're estimating. So one is the trade margin correction. The second piece is, like I pointed out for spices, we are going in for a full relaunch of our blend and we are entering the southern market with a completely different mix. So we did pull back our spices business to an extent to make sure that we hit the ground running when we come back new. And these are the two factors. But just to give you comfort on the Sampann business, it is a huge growth opportunity for us. Doesn't change. The total addressable market is huge. Pulses what? 155,000 crores. Spices is 60,000 crores. Spices is bigger than my tea business addressable market. So we're fully cognizant of that. But we've got to play in with the right margin. So that is why we probably took a pause. So but last 3 years CAGR, if you look at it, Sampann is still on a 30% CAGR. And by the way, July has still trended directionally in the same number. So that's the reason why HQ is very confident of coming back to that. So that's your answer on the Sampann question. Number two, in terms of where could Sampann go? See, Sampann, you remember, very, very high ROC for Sampann from a TCPL perspective. So it does unlock a strategic question for us as we go forward. And it will be, I would say, high single digits, low double digit margin is a very, very long-term aspiration. But we have various levers to pull to get there. Number one is, as we build scale, we've got to flex our procurement muscle, get better at that, including forward contracting, forecasting, all those pieces. Number two, we've got to get into distributed manufacturing because freight is a huge component in these pieces. We've just finished a piece of work in which we are relaying our entire network. We've got to execute that, which takes a bit of time. And number three, of course, we've got to bring our technology jobs to bear because our R&D team now needs to figure out how to value add into these categories. All I would give you on that front is I think we've built a fabulous R&D team, having invested in significant resources behind that. And in the next, I would hazard between 3 to 6 months, you will see some really differentiated products come in the Sampan-based business itself.
And that 5% on the packaged?
Oh, yeah. Oh, sorry. So Abhishek, absolutely right. The 5% on the package, pulses, etc., it will play to our advantage. One is the compliance on the ground, but especially in organized channels like e-commerce, modern trade, etc., where I would say a lot of competitors were playing on the borderline with a brand but not registered, so to speak. I think if the compliance is tightened up there, the premium that someone was charging vis-a-vis, how do I say, unbranded, local, loose, or brands which were not playing in the GST space, I think that would reduce. And therefore, we would see more consumers moving into our products. Because if there's one thing I've picked up across the country, different retailers, especially Kirana stores, right? The point is, if a consumer has picked up something and taken it home, then guaranteed you've got a consumer for life. The catch is getting the consumers to pick it. So apart from the GST piece, you would also see us starting to up the A&P on Sampan so that we start to get trials and therefore continued consumers.
So my last question is on the masala oats. So already entrenched players are there. Saffola is very dominant, and we have Quaker Oats also. So my question is, when you say 5 to 8% share in the current distribution, what would be the plan in terms of scale up of distribution and advertising versus Saffola over a 3-year time frame? And second is, we have seen in foods, if you are too niche, too healthy, there is a limited opportunity. Case in point is, for example, atta noodles. It has remained a smaller part. So just adding millet, and when you are so late, why should this product succeed?
So Abhish, first of all, let me clarify, we are looking at Soulful as a brand, and Soulful will play in many categories. Some will be large, some will be small. But we will only enter categories where we've got a right to win. Soulful, healthy brand, millet differentiator, better product profile, and the value proposition should work. And thereby, this is one of the very many extensions for Soulful that you will see. On a blind taste profile versus the leading competitor, we are a win because we are crunchier, because we've got ragi there, and of course the health quotient dials it. Now you're absolutely right. We've got to now up our game both on distribution and consumer communication to make sure we get traction. But I was just trying to give a perspective that within about 60 to 90 days of launch, we are already at a 5 to share in markets where we are present. Now, like I said, Soulful is our brand for breakfast, mini meals, and snacking. This is our first foray into snacking. I would say watch this space as we enter many more categories. The whole idea is Soulful overall, we are seeking to build a very large.
So thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Manoj Menon from ICICI Securities. Please go ahead.
I give a few clarifications, if I may. One, filling on the salt business. How do I look at the salt volume performance of the last couple of quarters? Is it just the high base of last year specifically, or is there any other big picture drivers here?
So Manoj, let me just say the reason why salt pricing is taken up is because of two factors inputting cost. Number one is brine. But number two, of late, the more important one is coal prices, right? Price more or less has been stable, but coal is what we did not see coming, if I may, and that is why we've taken up these prices. Now, that said, both energy costs as well as buying hits every single competitor in the market. So if you look at the raw salt prices out of the salt plants in Gujarat, it is up substantially versus last year, and therefore it closed down the chain. So therefore you will see, hopefully, you will see industry overall moving up. That said, if you dissect the salt pricing, the strength of the Tata salt, vacuum evaporated iodized salt is so strong that despite the fact that between last July, where we were at 21, and as we exited the quarter, we were at 25, the volume is flat. And we've been able to take up pricing and maintain market share, right? The negative volumes are mostly on account of traded salt, which there was a little bit of a hiccup up and down. But going forward, we should be able to correct that as well. But salt, I think, Manoj, I think the focus is given the fact that we have a very strong 38 share, given the fact that we've got probably the best distribution in town on salt, and the fact that we were slightly late to the party in anticipating that coal prices will move further up. We took another price correction from 25 to 28 at the end of the quarter. And like I said, we take price corrections in salt. There is a downstocking in channels because they do expect to go shopping around and find some cheaper Tata salt from some other trader, wholesaler, etc. I think you've seen a bit of that. But I would say this quarter you see stability coming back into the business. Again, like you rightly pointed out, it's negative 3% overall total salt in volume terms versus last quarter, same quarter last year of 17%. And the other thing I would want to highlight is, foods business, FY21 Q1, 20% growth, FY22 Q1, 20% growth, FY23 again 20% growth. So, if anything, I think we've been consistent.
Fair sir. So just two quick follow-ups only on the salt part of it. How do I think about the medium-term opportunity, let's say, to maximize or optimize profit pools for you, let's say using price as a lever in salt? That's one sub question. The second one is, let's say, in a scenario of, let's say, significant deflation in your input, let's say, prices, it could be coal, it could be grain, it could be any of those. Do you think that there is an opportunity to retain some of the, let's say, input deflation benefits that expand, let's say, the gross margins in perpetuity? Because obviously affecting your
So number one is the reason why we have taken pricing up. If you look at my last quarter, if you look at the three big commodities that we have on India beverages, right? We have expanded our margins by 1,000 basis points to put it where it should be. So we will drive for volume from here on. Second is India salt margins, gross margins declined by 500 basis points, and that's why we took up the prices. International more or less is stable margins after all the price increase, right? So salt, once we put the margins back on track, we will go for volume because we do think there is a share opportunity out there. On your question of as deflation comes in, the question is as and when deflation comes in, we will have to play very, very close to the ear. I would like to keep some of the margins, albeit I do not want to lose market share. I would want to continue market share. So again, it will be a tiered pricing approach. And if you look at the last 1 year, what we have done is now we've got brands across different price segments. We've got a rock salt and a set of salts playing at the higher end. We've got now Tata salt, the base vacuum evaporated salt. We've launched the fortified. We've got a high safety salt at the bottom. And we've just launched Shudh, which we are learning in the pilot, and we will again tweak the marketing mix to expand it across various geographies. So we will make sure that we do a portfolio play, give value to the consumers while, if possible, increasing margins consistently, But the whole idea is continue to gain market share. But you're right, salt is one of the big pillars basis which we will continue to have fuel to expand into other categories as we go forward.
Sure, sir. Thank you so much for the detailed response. I shall come back in the queue. Thank you.
Thank you. The next question is from the line of Trilok from Diamond Asia. Please go ahead.
Hi, good afternoon, sir. Thanks for the opportunity. Just want to understand on food business, how are we, obviously we are entering into new categories in the tech and also highlighted about the protein platform. What sort of, internal targets are we thinking from a growth perspective? You already alluded to one of the participants about the margin. But what's the growth that you should be happy with? Are you happy with 20% growth that you guys are clocking last 2-3 years?
So let me put it this way. I think food is going to be the big growth engine for us. Till now, even right now, if you look at it, it is overwhelmingly a salt driven business and now Sampann expansion. We have added different levers to the whole business across, including Tata Smart Foods, for example, in which there is a full relaunch in process to start driving into that category. So we have very clearly identified the platforms, and within those platforms, the categories where we will play, where we've got a right to win. It is a big growth opportunity, both in terms of size as well as momentum of growth in that category. We've got a right to win and expand. So we've just, for example, Sampann, we've identified dry fruits as a category. I would say in the 6 months, we've hit it out of the park only online. The run rate that we have on dry fruits is probably rivaling some of the new startups out there, and this is all within the last 6 months. That's the power of the Tata and the Tata Sampann brand name. So we will continue to expand. Foods is the big vector for growth for us. Sampann leading the charge, but it is also Soulful, Tata Smart Foods, where there is a full marketing mix planning going on. And of course, like I said, the idea is to continue to expand market share in salt. Are we happy with 20? Obviously not, right? We will be shooting for higher numbers as we go forward.
But just follow up on this, between when you enter new category, is the gross margin and profitability are key metrics, because these all are sort of high unorganized categories with obviously low margin profile as per our understanding.
So you're absolutely right. When we enter new categories, we do a full-fledged analysis of what is the size of the category, what is the scale that we can get, and what are the margins that we can get. Number one, you remember Sampann is a high ROC. I would say significantly high ROC because there's almost no capital on the ground per se. But we are very, very mindful about 2 things. Number one is wherever we are entering is incremental in terms of where we are entering. So all I would like to leave you with is compared to the base category, we are incremental in some of the things like protein, Soulful, significantly incremental, and some of the categories that we're entering with Sampann incremental to our current base. So the directional movement of margin will continue to be upwards.
Understood. Thank you very much. I will get back in to you.
Thank you. Next question is from the line of Jaykumar Doshi from Kotak. Please go ahead.
Yeah. Hi. Thanks for the opportunity. My question is on tea. When you look at 3-year volume CAGR, it's about 2.6%, which is much lower than 7-8% and 9% that you were tracking in the previous 2 quarters on 3-year CAGR basis. Is there a one-off, any kind of penalty stocking or anything in this quarter? And how should we think about the volume trajectory, either YOY or 3-year basis going forward for the rest of the year?
So you're absolutely right. I think we've seen a lot of yo-yos in the last 3 years, both on the price front as well as the volume front in the tea business. But if you right, structurally, still 1/3 of tea in India is unbranded. Number 2 is historically you've seen a 5% to 5 to 7% volume growth in the category itself. And the fact that we have not lost out our position in the category is shown by the fact that we've gained share in the category. Now, overall, this quarter compared to same quarter last year, we're cycling a very heavy revenue growth, but you're right in terms of volume, it's probably not come to pass. I would say one of the reasons, or two of the big reasons. Number one is the stress in certain specific geographies. I would say mostly rural across and the indie per se has been a bit of an issue. It's not come up. Hopefully, monsoon to bring it up. Coupled with the fact that we had an excess summer. And I would say proof of the fact lies in, if you look at all the soft drink majors and including our Narishko business, it's out of the park with struggling for killing. I think people move to cold rather than hot for some time. That's not an excuse for the business, but we do think as we go forward, volume growth should come back. Now the other piece that I would leave you with is in our portfolio, our focus has been to grow the mass premium and premium because that is a share opportunity. But more than that, the stress in the rural and the indie belts has been showing in the lower end of our portfolio. And that's the reason why you're seeing a margin expansion of 1,000 basis points in the tea business. But now that the margins are back on track, we will be going for volume growth. In fact, we have just given up some more pricing in the north and coupled with our distribution drive, which is we are going to top gear and expansion on the total number of outlets we reach. And in the cover, we do think we will get the volume growth back to, I would use the word par for the India business.
Understood. Could you give a little bit outlook on raw material prices given there was flooding in Assam, whether the second flush, which is where you do bulk of your buying, how has pricing trended and what it means for tea gross margin going forward? Will it sustain at these levels with the scope for further improvement?
So I would say essentially, given the fact that we had expected this year to be a normal year, we had seen a downtrend in tea prices, both North India and South India, till the middle of June, were an unexpected event. That said, I think finally the impact had probably about 30 days of dropping or so. But you have to remember one fundamental structural point in the India tea business, supply is greater than demand. And whenever there is supply greater than demand, prices do trend downwards. So therefore, while we have seen a blip, I would term it a blip for a short term, and you might see some impact maybe for a quarter or so, but not as significant as the blip that you saw. I would say secular, you will be pricing trending downwards and then staying in a range. So while we do see a small blip, I don't think we need to course correct this time. There might be a small dip in margin, but like I said, from month of FY22 to Q1 of FY23, we expanded margins in the India tea business by 1,000 basis points. So we are in the ballpark of where we want to be. We will have some puts and takes, but again, it's a fine balance between top line and margin. We don't expect margins to be as depressed as they were during the COVID lockdowns, etc. Small blip, but something we should be taking our stride and moving ahead.
Sure. Final quick one. When we visit some modern trade outlets in this side of the country, I mean, they sell some loose pulses and staples that, essentially to benefit from the GST. So, will that still continue? So, recently, what is essentially the definition of label? Can modern trade outlets sell loose sort of pulses and other sort of staple products without customers incurring GST?
So now I wouldn't hazard about what they can sell and what they cannot sell. All I can tell you, GST regulations which have come out is very specifically anything that is packed before source or before the selling point has to pay GST. The only thing which is exempt from GST is one that is packed to order. So if I can use some GST Hindi out here, बोरी में से elastic bag में डाला के उधर सील करके दिया. So then there is no GST. But that is not what happens in modern trade and online. And therefore, and I use the term, if there is compliance, we hope to see advantage.
Understood. Thank you so much.
Thank you. The next question is from the line of Sheila Rathi from Morgan Stanley. Please go ahead. Sheila, may I request that you rank from your side and go to the question, please?
Thank you for taking my question, and hello, please. My first question was, again, with respect to the food business. Just wanted to understand your strategy going ahead, with respect to the distribution. Because you just said that, the dry food business being very strong, demand on the online side. However, I feel that scaling on the food business will require a lot of offline strategy, which is on the GT and MT side. So just wanted to understand what's the strategy and where are we with respect to the distribution reach of Sampann as well as Cold Food?
Sheila, absolutely right. If you really want to scale any of these staples, if I may call it, you do need to play the GT game. The reason.
Participants, please stay connected. Line for the management dropped. Ladies and gentlemen, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management be connected. So you may go ahead.
Yeah, so Sheila, to answer your question, the reason why I alluded to dry fruits was, in today's world, the online platforms provide you a fantastic piloting opportunity. So that is why we launched it only online, because there it is no one between you and the consumer. You're on the platform, you're deciding the whole marketing mix, consumer sees it online and therefore picks it up. After that, if the proposition is strong, then you've got to get into distribution and put it into the stores where there is something called a retailer standing between you and the consumer. So now that we've proved the proposition, now we've got to tweak the whole mix to make sure we're well distributed. And given the fact that we are going to be touching 1.5 million outlets by September 2023, and hopefully we are already at 2.7 million indirect reach, total numeric reach if you count. I think we've got the scale to do it. In the staples category, it takes a little bit of time because you're competing against rules even backed by the retailer themselves at certain points. But I think we've demonstrated with a CAGR of 30% with Sampann that we are capable of doing it. The idea is now to take the dry fruits proposition into the GT and modern trade for that matter. And that is work in process. You should start seeing it coming to some of the modern trade channels very shortly. On where are we with respect to distribution of Sampann and Soulful, I would say we made significant progress. For example, Soulful, which we acquired about 18 months back at about 15,000 outlets, we are on a 3-monthly billing basis, which is how we measure availability. We're close to 400,000 outlets. So very, very, and this is we're only counting direct outlets. So this is about 25% of our total outlets. And it would be a very similar number for Sampann as well. That said, I think the fastest expansion in our 1.5 million base, which we should have by March, is you should see the wind of expansion, because I don't think you'll find too many more outlets which will stock more teas, but Sampann, Soulful, Smart Foods, that is what we will now seek to exploit.
Thank you. And my second and final question is, again on food, is with respect to the new categories which we are getting into. Do we think that this is the right time to get into more and more categories, or first, kind of stabilize the, base business and, reach a certain level of margins and then probably get into more and more categories? And I just wanted to understand your thoughts on that.
No, Sheila, absolutely right question, and that is why I keep asking to my team that in any category, especially established categories, it is market share and margin. As long as we are on the right track, that is when you start moving and start moving into other pieces. And I mentioned my beverages margins is back on track with a 1,000 basis point increase. My foods, my salt business was down 500 points. We've taken a 25 to 28 pricing and stabilized that. We do think we will not have hiccups on the way to maintain market share in both beverages and salt. And that is why we are now moving into other categories. For me, it's not a or game, it's an and game. And Sampann as a portfolio has huge, I would say under-leveraged equity, if I may. We've not executed to the team, and that's why we are moving into this category. As for if you're alluding into protein, etc., you are right, there will not be same categories today, but we do think it is important for us to have first mover advantage, put a stake in the ground that we are one of the leaders out there, and build the entire platforms as we go forward. But we have the advantage of having, I would say, strong brands, great team, good execution, and stable margins, if I may, in our base category, which will afford us to do that.
And just one final follow-up here. You just said great team. So are we really hiring in terms of at the senior level, in terms of because we are moving into many categories, or we are just maintaining the same team?
So let me put it this way. I think we've got a very strong senior leadership team now. We've sort of expanded over the last 2 years. That's number one. The big expansions which is happening in foods, we've ramped up the team significantly. Apart from that, we've ramped up the R&D team because we need to up the ante on innovation and how do I say, the scientific basis behind all these new categories. We are investing in behind creating very strong R&D infrastructure and resources for this team. We have expanded significantly in digital, where we do think it will drive both efficiency and effectiveness going forward. And now we're taking digital into the next phase of data analytics, etc., including in our procurement scenarios, for example. So, answer to your point is, we are adding across the board in spaces where we see either get efficient or we need to add as we expand categories.
Understood. Thank you. That's it. Thanks, everyone. May I please request everyone to restrict their questions to one so that we can address everyone's questions. And given that it's 12:55 already, if I could just request to extend the call by another 10 minutes, so we hold the call until 1:10. Yes, moderator, on to you.
Thank you. The next question is from the line of Percy Panthaki from India Infoline. Please go ahead.
Hi, sir. Am I audible?
Yes, sir.
Yeah. So, your NARISCO growth, if you just continue to grow this fast, I'm sure in a couple of years you would be clocking close to 1,000 crores per annum. So, at that kind of scale, what kind of EBITDA margins can this business generate? That's one thing I wanted to ask. And second thing is on tea. We had done this acquisition of Lal Goda, Kala Goda teas in Rajasthan. Can you give us some update on what is the success of that acquisition in terms of what was the market share immediately after the acquisition and what is the market share today? And if that has been a good experience, do we plan to do such small acquisitions in sort of individual states in our tea business, or that sort of is not something which is of priority right now?
So, first of all, I should say it's a fantastic business, again, from an ROC perspective, right? Because we are all on a third-party basis, both in terms of manufacturing as well as distribution. We put our resources into supervising the sales and the marketing, branding, product development, and all those kind of phases. So that's number one. We clocked 180 crores last quarter, so you're absolutely right. It's on trajectory to get to a 4-digit business very quickly. All I will leave you with is the margins in NARISCO are accretive to quite a lot of my current portfolio. So that's number one. And we had bought in NARISCO with that whole premise, right? Given the fact that it was a strong business operating in a very small playing field, if I may, expanding both portfolio and geography would give us disproportionate growth. That was the whole logic. So absolutely right, and we are full press ahead on that piece. That's number one. Number two, on your Lal Goda, Kala Goda, I would answer you the second question out there. Ultimately, it's about creating value for shareholders, right? So do I put my money into growing Sampan or do I go and buy a small tea brand in a part of the country? I think that's a critical piece. And in tea, what is that? What is that amount of money that we're putting that we should be able to get better out of an acquisition than what I can't do myself? That is the other question to ask, right? Capital allocation, if I may. From that perspective, I don't think you will see us doing too many small tea acquisitions. I think our ability to do it organically, if we really put the money there, that's number one. And number two, if I pick up my choices of where to put the money, I think there is significant opportunity in many of the newer categories that we're going with. Langkara Kola, which I think has performed more or less to expectations, but is it hitting it out of the park? I don't think so. But I mean, it has fulfilled the business case, more or less, that we had gone in with.
Okay, sir. That's all from me. Thanks and all this. Thank you. Next question is from the line of Amit Purohit from Minara Capital PLC. Please go ahead.
Yeah, thank you, sir, for the opportunity. And just one question on the salt food business, indicated price increases. So going forward, how do you see the margins in the food business? We were talking close to about in the band of around 11 to 13%, 14% margin. Should this price hike bring us closer to a double-digit margin, or how do you see this for the year and going forward?
Yeah, I did allude to it. Gross margins in salt, if you compare it to the same quarter last year, we're down by 500 basis points, right? And the reason why we moved up the pricing from 25 to 28 is to put the margins back on track. I do think we will come back to a stable state once we put this pricing back. So this quarter, at least, you will see the margins come back on track. There might be a little bit of ups and downs in the beginning of the quarter as the price settles into the market. But like I said, given the fact that the pricing is being taken because of cost increases in energy and brine, which are hitting everyone in the market, I don't think you should see too much momentum market share per se.
And just one small thing on the Gujarat aids which have happened. I mean, is that going to have a better competitive advantage for us? Is the supply side for some of the competition is a bit inferior than us? Or it's every year phenomena and nothing much to hear? Hello?
The reason why the brine prices have gone up was because of the extended monsoons last year. Unfortunately, there were some heavier rains in Gujarat in the beginning of the monsoon season, and that's why the corrections which we were expecting to see in brine have not happened. But that said, there has been almost no movement up or down, marginally, if I may add. I would say the picture will become clearer towards the end of September is when the final monsoons have retreated and you know where we stand in terms of the net output from the brine field. As of now, we're seeing brine prices elevated but stable from where they were. The big moment that we saw was in coal prices because of which we've taken the price increase.
Okay. Thanks a lot.
Thank you. Next question is from the line of Sumant Kumar from Motilal Financial Services. Please go.
Yeah, my question is regarding Narisco. So can you talk about the channel expansion for Narisco and what is our target for next 3 to 5 years?
So Narisco, effectively, I think we are not mistaken about 350,000 outlets nationally. This is what we touch, which is a significant increase from where it was. So I wouldn't want to hazard a guess. I think all is in our court as to figure out how high is high. From about operating in about 25% of the geography, of the Indian geography, we're probably at a 70%. We've still got a long way to go. So you could see continued growth on Narisco for some time to come as we expand geography. And apart from that, like I said, in Narisco, it's not only the base Tata Gluco Plus business, the Tata Copper Water is really scaling up. Apart from that, we are in the process of launching, we've launched Delhi in cups, but unfortunately in season we were out of capacity. Couldn't really expand that. We'll see the expansion happening now. In Fruski, you'll find a jelly drink coming out. We've launched Tata ORS. We've launched Tata Nature Alive. The Narishko business has put Himalayan back on track because of which now EBIT is positive. I think huge amount of work done, but a long runway yet to go.
Okay. Thank you so much.
Moderator, perhaps we can go to the webcast to take a few questions. So, Sunil, there is a question from Tejas at Spark Capital. He's asking, apart from the inflationary pressures in salt category, there seems to be a sequential contraction in 4Q versus 1Q in gross margins in past as well. Is there any underlying seasonality playing out here?
I would ask LK to comment, but my top line there would be.
Sorry, we are unable to hear.
So normally you have slightly higher seasonality in beverages in Q3, Q4, and compared to a Q1, maybe there's a little bit of that. We're actually not. We don't think there is too much pieces of that. But the salt cost pressure would have played a significant impact. And the other pieces, I think the freight and logistics inflation which is coming, I think we're seeing more of an impact of that in Q1 versus Q4. But that said, given the fact that we're seeing a declining trend on crude, we should hopefully see that piece starting to stabilize, if not inch downwards. But
there's no material underlying seasonality, but it's really to do with inflation on coal, brine, overall freight costs as well. So no specific seasonality.
Thank you. And the second question from him is, the heightened A&P spend that we incurred, was it to support the existing portfolio mainly or to support new launches?
I think it was a mix of both. And Tejas, just at the point of view, if you look at, we had initially itself, our hypothesis was that we were relying quite a lot on the Tata brand name. So if you look at our share of voice versus share of market, which is the standard benchmark used in all FMCG categories, we were slightly behind. Now we have upped the spend. Again, if you look at most of the FMCG majors, your A&S line, advertising and sales promotion line, ASP line, compared to sales, is anywhere between, I would say, 6.5, 7 to about, about 10, 11%. We were quite behind the curve. We have ramped it up. Even for the last quarter, we have upped the number to 6.4 versus 5.3 of last year. So I would say we are coming to par right now on the overall spend. But the spend is both behind base as well as new launches. Just that, also mindful that we are not scattering it across brands. For example, in tea, we are now distilling it down to 4 or 5 umbrella brands, and therefore advertising in one variant as a rub-off on the mother brand. We are leveraging Soulful for breakfast, mini meals, and snacking. So advertising in one particular segment will have a rub-off. So efficiency of the spend is also something that we're looking at closely.
And the last question is, Sunil, how are we tracking in market share in e-commerce and modern trade versus GT in tea and coffee?
So as I think to Sheila's question, I had mentioned that the beauty in e-commerce is that it is only you and the consumer. There is no one else in between, and therefore it is the power of your product and your brand and your value proposition to the consumer. We are still market leaders by far on e-commerce and tea, and we are lagging behind on GT, for example. Modern trade is better than GT, and e-commerce is better than modern trade. We are leaders in e-commerce, and that again puts the ball into our court on expanding distribution and making sure availability is there in the outlet. We lag competition on numeric distribution by about 10%, and our market share is off by about 7 to 10% again versus the market leader. The hypothesis being if we cover the reach, we should be able to cover the market share, and that is why the immense focus on distribution.
Okay, and the final question from Shreyan Gathani is, can you talk about restructuring costs and their recurring nature in the past few quarters? When can we expect complete restructuring to take place?
I would use the term that I use with one of my team. We are a work in process company. We're still not finished where we want to be. It is still not stable state. We've got a long way to go. Aspirations are very large. This quarter, the restructuring. So in the past, we have seen restructuring costs because we had cut down layers in our teams. As we acquired some of the businesses, we rejigged the teams to make sure we are deriving synergies. So while long term you will derive synergies, there will be some short term restructuring costs to make sure the business is right size. Last quarter you would have seen it, or previous quarter you would have seen it with regard to Tata Smart Foods. Last quarter there were some costs, and I think the picture is yet to be played out in terms of the entire international and India Tata Coffee restructuring that we have announced. We've still not executed fully because we don't have full regulatory approval. But restructuring, I think at least in the short term, you could see this cost coming out. But all I can assure you is that fundamentally this is to right size and make the business much more effective and efficient. And therefore, in the longer term, it will bear phenomenal fruit. So that before we put in restructuring costs, we always do a business case analysis, look at the payback, and then press the trigger.
Moderator, given the paucity of time, we'll just take two last questions.
Thank you. The next question is from the line of Richard from JM Financial. Please go ahead.
Hi, thank you for taking my question. So I have two questions here. So in categories like salt and considering all the value added and premiumization initiatives from your end, what could be the growth rate of this category like let's say 5 to 7 years out versus your say estimated 24,500 crore turnover in this business? Do you see this business at like let's say 4 to 5,000 crore in the next 5 to 6 years time frame, given how it's been growing, and what could be the risks in this kind of a adoption?
So Richard, I wouldn't hazard a guess of 4 or 5,000 crores. It will get to that, but the time frame I think is a matter of time. That's number one. I would say I would continue to shoot for expanded market share, expanded price realization, and continued expansion of the portfolio as we go forward. Right? Just to give you a perspective, we were a 30 share exactly 2 years and 4 months back when we took over the portfolio. We are at 38 share now, and we continue to expand the market share. So double-digit revenue growth, I think, is a given.
Okay. Over a period of time, you think double-digit revenue growth?
Oh, yeah. So that I can assure you that I think we can put enough pressure on all our teams to make sure we are continuing to deliver double-digit growth for some time to come.
And what do you think would be a risk to that double-digit assumption?
I think basically salt is, I think the ball is in our court on execution. I don't think it is as much we are in 38 share. Number one. Number two, we've levered the entire or layered the entire value proposition right from entry salt, right out of premium salt. So we have the ability to pull levers across various price points. We are offering a full portfolio. It's a question of there might be subtle shifts in consumer preferences. We've got to play to that. I do think we are slightly ahead of the curve on that piece, including the 30% lower sodium salt, for example, or some of the new launches which you will see in the next 30, 60 days. I actually think the risk is in our ability to execute.
All right. And one more on Sampann. You talked about trade realignment and change in terms of trade and margin, etc. How much would this exercise boost your Sampann business margin by? And against that, how does this impact ROCE for the trade partners?
I wouldn't comment on the ROCE for the partners. The calculation. All I can say is Sampann is a very, very high ROCE business for me. And in Sampann, I think we've got to be mindful about the fact that you've got to maintain a healthy margin while continuing to press the accelerator on top line. in various other staple categories you've seen in the initial phases of category development, you will have a lower margin, which you've got to figure out ways to build it as you go forward. So that is where we are. I would think we have put Sampann back onto a margin profile where we would want it to be. Is it the best of places to be? No. I think it's still got way to go. But again, like I said, we need to get back to the 30-35% plus CAGR on the top line. And it will be a periodic, I keep using this term with Didi, it's a snake in a tube, right? You will have yo-yos, but directionally it will keep pointing upwards.
And sorry, just last one. So the trade realignment and the boost in the Sampann margin, I mean, this was necessary for you to get to that high single digit and low double digit long-term spices margin that we talked about.
Which is spices, they are in a comfortable position. It was the pulses and recent category which we corrected. And I would say mid plus single digits, mid to high single digits margin is where we have landed up. It was getting slight bit of erosion. And Richard, I am not a fan of going to very low margins, very low EBIT and going for high top lines because after that correcting it is a huge problem. I am more a proponent of go full-fledged on top line for some time with decent margins, correct margins, and press the accelerator. So right now, I think we're in a comfortable place to push the accelerator for the next phase.
Fantastic. And did you say that the long-term horizon for the margin for this whole Sampann business is 5 single digit and low double digit?
It is, yeah, absolutely.
And how many years out would that be?
I would want it to be as quickly as possible. I think it takes time to get our procurement engines right with scale. We'll take time to put our entire network in place. We will take time to roll out all the value additions that we have envisaged. Like I said, you will find some path-breaking innovation from Sampann coming out in the next 60, 90 days or so, which will show you directionally where we are headed in terms of ramping up the margin and premium profile.
Got it. Thank you very much, sir. Wish you all the best.
Thank you. The next question is from the line of Devika Jain from Ratnagiri Investments. Please go ahead.
Hi, thank you for taking my question. So I wanted to understand what would be the impact on our tea business given the inflationary trend that's happening in Europe?
If you are asking for inflationary trend on the tea business in international because of what's happening in Europe. So it is not only Europe. You saw the graph on Kenyan tea, which has moved up versus last year. Added to that, the inflationary both in terms of gasoline prices, which has an impact on packaging, freight, and overall cost of doing business. That is one of the reasons why we've taken some aggressive price increases. US is primarily coffee, which we've already taken up and stabilized the margins per se, and by the way, gain share. Our big business of Canada, I think, is on right track, having already implemented the price increases. In the UK, while we had announced the price increases are still not landed because there are several large retailers to deal through with on the execution piece. But I think the last pieces of the puzzle have fallen into place end of last quarter. So our margin should be back on track. Will volumes be slightly impacted? I would think so. But I think revenues and margins will be on the right trajectory, which is what I would target for in the international space.
Okay, got it. And a second question. So I wanted to know the reason why we're losing market share in the international market, both coffee as well as tea, like every quarter, value market share.
So as I mentioned, in the US market, our coffee market share is back on track and started moving up. Branded brands are moving faster than K-Cups. K-Cups also you should start seeing the share going up. Canada again is starting to move up. Canada, we are anyway in the number one position overall per se. In the UK, there is work to do versus Nasti versus specialty and urban. That is the reason why we are putting money behind tea cakes, because we do think there is enormous amount of growth to be had there. We see the overall growth of T-Pigs versus the rest of the portfolio, and the action has started to move. By the way, T-Pigs was the fastest growing specialty brand in the US also in the past quarter. So we've got to play the right profile of where the growth is. Lacti is almost stagnant. The growth is happening fruit and apples. And specialty, that is where we're putting our money, starting to move the curve. I think it is a matter of time before you start seeing the share trajectories change shape.
Okay, got it. Thanks. Yeah, I think it's that. Yeah, we'll just conclude because we've run out of time, and I'll just kind of conclude. So thank you everyone for joining us on behalf of the management. Sorry for having to extend the call, but if you do have any further questions, you can get in touch with me. Thanks Manoj and team for hosting us.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.